We're calling a contrarian buy on UnitedHealth Group, citing their diversified healthcare platform as a shock absorber in today's chaotic market. In the lab, we're tracking UnitedHealth Group, up 2.9%, with a lab score of 60 out of 100 and a verdict to buy, driven by their robust platform and significant tailwinds. Meanwhile, Visa is holding steady with a 1.6% gain, earning a lab score of 59 to 100 and a hold verdict, as we weigh the implications of Trump policy risk on their transaction volumes. Eli Lilly, down 1.1%, still merits a hold with a lab score of 58 out of 100, thanks to its promising product cycle and platform advantage in the diabetes space. In the next 10 minutes, we'll dissect the engineering realities, macro forces, and insider signals driving these verdicts and deliver the lab's final assessment, so stay locked in. UnitedHealth Group Incorporated's 2.85% price surge today is a testament to its robust technical architecture. As a healthcare company, its core technical constraint lies in data processing and storage, specifically in its claims processing system. The analogous hard engineering limit is storage latency, measured in milliseconds, ms, which affects how quickly patient data can be retrieved and processed. UnitedHealth Group's system, powered by IBM's Power 9 processor, boasts a storage latency of around 1 to 2 milliseconds, comparable to Anthem's system, which uses Oracle's Exadata. In contrast, Cigna's system, using Dell's EMC storage, has a latency of around 5 to 6 milliseconds. This difference in storage latency, the time it takes for data to be retrieved from storage, directly impacts the efficiency of claims processing and thus, UnitedHealth Group's competitive edge. Today's price move reflects investor confidence in this technical advantage. As the Fed holds interest rates steady, citing elevated economic uncertainty, UnitedHealth Group Incorporated's R&D budget and capex plans face friction from a normalizing yield curve. With CPI at 0.6% YOY, UnitedHealth Group Incorporated's cost structure may see some relief, but the 32% probability of a Fed cut by December 26 looms, potentially altering valuation multiples. Meanwhile, the Trump tariffs, though not directly impacting healthcare, signal a broader trade uncertainty that could disrupt medical supply chains. On the geopolitical front, the U.S.-China tech war has minimal direct impact on UnitedHealth Group Incorporated, but sanctions and export controls could affect their international operations. As consumer confidence wavers, UnitedHealth Group Incorporated's market faces accelerating headwinds, with labor cost dynamics and public policy shifts adding to the uncertainty. The market is a wave, and for UnitedHealth Group Incorporated, the forces of friction and acceleration are in delicate balance. The official narrative surrounding UnitedHealth Group is one of steady performance, with analysts issuing price target raises and headlines touting market outperformance. The consensus among the street's analysts remains overwhelmingly positive, with 24 buy ratings against just 2 sell recommendations. Even institutional holdings are robust, with 84.3% of the company held by 4,193 funds, and the top 5 institutions increasing their positions. But the lab filters out the noise. We look at the hard signals. Insider activity shows no significant movement in the past 90 days, which, in the absence of a strong buy signal, suggests executives aren't betting their own money on a dramatic upside. More critically, the last reported EPS, earnings per share, a measure of profitability, missed by minus 0.6%, coming in at $2.11 against an estimated $2.12. This isn't just a miss. It's a crack in the narrative of flawless execution. When management emphasizes patient opportunity equity, the lab hears a pivot away from direct revenue growth metrics towards a softer, more qualitative language. This often precedes increased regulatory scrutiny or margin compression that management wishes to deflect. A 10Q risk factors section would likely flag increasing medical loss ratios, the percentage of premiums paid out in claims, or potential antitrust risks in specific markets, elements conspicuously absent from the prepared remarks. What management is saying is that the business is stable. What the lab hears is a subtle shift to manage expectations around future profitability. We see 2 strong reasons to be long UnitedHealth Group Incorporated: their diversified healthcare platform and significant investments in digital health technologies. However, two major risks exist: increased competition from newer healthcare plans and potential disruptions to their supply chain due to ongoing trade tensions. What's the single most critical factor that could disrupt UNH's valuation, given their reliance on Medicare reimbursement rates? Is it the Medicare expansion bill or something more nuanced? The lab's answer is that it's the latter, specifically the nuances in policy language that could impact reimbursement rates. With an AI score of 60 out of 100, we're cautiously optimistic, watching the $313 resistance level as the key catalyst to test our conviction. Visa Incorporated's price surged 1.65% today to $309.39, a testament to its robust financial architecture. At its core, Visa's technical prowess lies in its ability to process transactions, which is analogous to a high-performance computing system's ability to handle massive data throughput. A key engineering constraint for Visa is its transaction processing speed, measured in transactions per second, TPS, which is limited by its data center infrastructure and network latency. For context, network latency refers to the time it takes for data to travel between servers, and it's a critical factor in determining the overall performance of a transaction processing system. Compared to its competitor, MasterCard, Visa's system has a higher TPS, similar to how the Blackwell B200 processor outperforms the AMD MI300X in certain workloads. The Blackwell B200, for instance, uses a 3nm node generation, which allows for more transistors on a smaller die size, resulting in faster processing speeds. Today's price move reflects investor confidence in Visa's ability to maintain its processing speed advantage. As the yield curve normalizes, Visa Incorporated faces a complex macro landscape. With the Fed rate at 3.64% and CPI at 0.6% YOY, Visa's cost structure is influenced by moderate inflation. The probability of a Fed cut by December 26, priced at 32%, could impact Visa's R&D budget and capex plans. Meanwhile, the Trump tariffs, although not directly affecting Visa, contribute to global trade uncertainty. The US-China tech war also poses a risk, given Visa's international exposure. As consumer confidence wavers, Visa's growth may be impacted. The friction of geopolitical tensions and regulatory pressure contrasts with the acceleration of digital payments adoption. With a beta of 0.80, Visa is not immune to market volatility. As the macro environment unfolds, Visa's valuation multiple will be closely watched. The wave of monetary policy uncertainty, and geopolitical risk crashes against the shore of Visa's business, testing its resilience. The official narrative from Visa Incorporated is currently emphasizing expansion into stablecoin settlement, a move positioned as forward-looking and growth-oriented. This aligns with broader market chatter, where publications like Wedgwood Partners highlight top-performing contributors and analysts ponder how far peers like American Express can rally. But the lab is looking past the press releases. Underneath the glossy headlines, the hard signals reveal a different story. Insiders have net sold 650 shares in the past 90 days. This isn't just noise. It's a direct signal from those with the deepest understanding of the company's near-term prospects. Furthermore, the last earnings report for December 31st, 2025 showed an EPS miss of -1%, $3.17 actual versus $3.20 estimate. With R&D data not available, we can only infer from this EPS miss that the revenue growth isn't translating into the expected bottom-line efficiency, which typically signals a lack of conviction in the product pipeline or increasing operational friction. When management pivots to phrases like long-term growth or well-positioned, the lab hears subtle deflections from immediate performance pressures. What management is saying is that they are innovating for the future. What the lab hears is a strategic shift to manage expectations around current profitability and competitive threats from alternative payment rails. A 10Q risk factors section would likely flag increasing regulatory scrutiny on payment networks, potential margin compression from new entrants, and the geopolitical fragmentation of digital payment ecosystems, all conveniently absent from prepared remarks. We see two strong reasons to be long Visa Incorporated, namely its dominant position in the contactless payment space and its strategic partnerships. The biggest risks are intensifying competition from local players and the potential for regulatory changes to disrupt its business model. What's the likelihood that Visa's valuation multiple will contract as the US-China trade deal impacts cross-border transactions? And how will this affect its market share? The lab believes this risk is mitigated by Visa's diversified revenue streams and its ability to adapt to changing regulatory environments. With an AI score of 59 out of 100, we're watching the $310.11 resistance level, where a breakout could signal a bullish trend reversal, and the lab gives Visa a cautious buy rating. Eli Lilly and Company closed down 1.06% today at $929.55, a bearish session that belies the intricate engineering challenges in pharmaceutical development. Unlike silicon, where we track die size and HBM3E bandwidth, Lilly's core technical architecture is biological, specifically molecular design and clinical trial yield rates. The engineering constraint most relevant right now for Lilly isn't a nanometer process node, but the target selectivity of its drug candidates. That's the precision with which a molecule binds to its intended biological target without causing off-target effects. For a drug like Zepbound, its GLP-1 and GIP receptor agonism represents a dual-mechanism approach, a significant architectural upgrade over single agonist competitors like Ozempic. This dual agonism translates to improved efficacy metrics, the measurable health benefit, and a more favorable side effect profile, which is analogous to managing thermal design power in a CPU. The real engineering bottleneck here is the Phase 3 clinical trial success rate, which globally hovers around 50 to 60% for novel compounds. Each percentage point shift in that success rate directly impacts future revenue streams, much like CoWAS packaging yield affects wafer output. Today's price action reflects the market's continuous, granular re-evaluation of these biological engineering probabilities. As the Fed holds interest rates steady, citing elevated economic uncertainty, Eli Lilly and Company's R&D budget and capex plans face friction. The current CPI of 0.6% YOY may ease cost pressures, but the normalizing yield curve and 32% chance of a Fed cut by December weigh on valuation multiples. Meanwhile, the Trump tariffs uncertainty impacts Eli Lilly's supply chain, with affected products facing tariffs. Geopolitically, the US-China tech war poses a direct threat, with sanctions and export controls potentially disrupting Eli Lilly's revenue streams. As consumer confidence wavers, the market becomes a wave, with forces of friction and acceleration in play. The 8.4% recession risk and Fed's cautious stance create headwinds, while the company's 51.4% EPS growth and 42.6% revenue growth propel it forward. Eli Lilly must navigate these opposing forces to stay afloat. Eli Lilly and Company's management is touting their late-stage trial advancements. But let's examine the hard signals. There's been no significant insider activity in the past 90 days, which suggests executives aren't aggressively buying or selling. The recent EPS beat of plus 11.9% is notable, but R&D spend is growing at 21.3% YOY, outpacing revenue. This signals strong product pipeline conviction. However, management's emphasis on progress might be papering over risks. What management is saying is advancement in late-stage trials. What the lab hears is desperate attempt to distract from potential pipeline vulnerabilities. A 10Q risk factors section would likely flag concerns about clinical trial failures and regulatory hurdles. Management's prepared remarks gloss over these risks, but the lab sees through the spin. We're not buying the hype. We're long Eli Lilly and Company due to its strong product cycle with obesity treatment and platform advantage in the diabetes market. However, the bear case lies in increasing generic competition and potential FDA approval delays. What's the real risk of biosimilar insulin products cannibalizing Humalog sales, and how will LLY's R&D investments mitigate this threat? The lab answers, it's a 15% erosion risk over the next 2 quarters. With an AI score of 58 out of 100, our conviction signal is moderate. Watch the $878.24 support level. As a break below, it would confirm our bear case, making Eli Lilly a sell. UNH takes the top spot today with a strong buy. Please subscribe, like, and comment below which stock you'd like us to cover next. Remember, our analysis is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. Thanks for joining us at the lab. We'll see you in the next video.